right now we have cryptocurrency getting close to their all-time highs, the stock market making all-time highs, yet we're still in this period where we haven't felt the full ramifications from the interest rates hikes that started taking place March 2022. Welcome, investors. The stock market makes all-time highs. Does that mean the recession is officially canceled? An inflation data release shows inflation is still running hot. What does that mean for the economy, and what does that mean for markets? Because they're not the same. We're going to get right into it. So I've been getting calls all week, all last week. Jake, the stock market's making all-time highs. Are we buying Nvidia stock? It's up 60% for the year. We should be buying Nvidia stock. And I would say, of course we're considering them, but we make investments strategically when there's value and a return on investment can take place in our given time frame of investment. And I want to go more in detail just what I'm talking about. Now, I want to start with an interview with Bill Ackman and Lex Fridman. Bill Ackman is CEO of Pershing Square. He's one of the largest hedge fund managers in the entire world. He's a renowned investor, very good at what he does. He consistently makes money year over year in good and bad markets. He's one of a kind. Lex Fridman is just an interviewer. He runs a podcast, very successful podcast, and he asks really good questions, so I do enjoy his show. And this interview is kind of deciphering between the price of something and the value of something, which are completely different. Just because prices are all-time highs doesn't necessarily mean that the value of a stock or an asset is worth it at the time. But I'm going to let Mr. Ackman speak for himself, and then we'll decipher and discuss what he's exactly saying afterwards. So let's listen.
That you have to understand the difference between price and value, right? Price is what you pay, value is what you get. And he said the stock market is here to serve you, right? And it's a bit like the neighbor that comes by every day and makes you an offer for your house. Makes you a stupid offer, you ignore it. Makes you a great offer, you can take it. And that's the stock market. And the key is to figure out what something's worth. And you have to kind of weigh it. He talked about the difference between, he said the stock market in the short term is a voting machine. It represents speculative interests, supply and demand of people in the short term. But in the long term, the stock market's a weighing machine, much more accurate. It's going to tell you what something is worth. And so if you can divine what something's worth, then you can really take advantage of the market because it's really here to help you. And that's kind of the message of the book.
In that same way, there's a kind of difference between speculation and investing.
Yeah. Speculation is it's a bit like trading crypto, right?
Strong words.
Well, short-term trading crypto. Maybe in the long run, there's intrinsic value, but it's many investors, in a bubble going into the crash. Were really just pure speculators. They didn't know what things were worth. They just knew they were going up.
So what is Ackman telling us there? In the short term, that's where we can take advantage of prices, price action. Sometimes people are speculating. Prices are going through the roof. Sometimes people are very fearful. They're scared. They don't want to buy. In the short term is where we can take advantage of the price action. And because over the long term, the markets are fundamentally accurate. They're fundamentally strong. They're fundamentally have decided what the actual value of something is. But it takes over the long term for us to finally realize that. So as sophisticated investors, what we're looking at is in the short term, what are things are happening right now, and what's likely going to take place in the future. Nothing is 100%. All we can do is move the probability in our favor. That's what we can do. Nothing is guaranteed in this world. I mean, the only thing guaranteed, I guess you could say, is government bonds. But even that is not. I mean, if something could happen to the United States government, is the chances likely? Very, very slim to none. So that's why we can say, hey, when we're purchasing this treasury bill, treasury bond, treasury note, we can say with near high certainty or near certainty that nothing's going to happen to these funds. The U.S. government's not going insolvent, and if they did, we have a whole nother mess on our hands. Now, right now, we have cryptocurrencies getting close to their all-time highs, the stock market making all-time highs. Yet we're still in this period where we haven't felt the full ramifications from the interest rates hikes that started taking place March 2022. Because there's something known as long and variable lags, where when interest rates or monetary policy becomes restricted, and when interest rates get raised, getting money, getting access to capital becomes difficult because it's more expensive. So therefore, it restricts the money supply. And when this happens, it takes 12 to 29 months, somewhere in that window, when we start to feel the full ramifications, and that's when bad things can take place, not always, but a large percentage of the time. And there's indicators, there's two types of indicators that we look at. Coincidental, which are things, data that we're seeing right now. They're the jobs numbers, they're the manufacturing numbers. And then there's leading indicators. That would be your inverted yield curve. Things that are going to tell us in the future what's likely going to happen. There's no one leading indicator that tells us, hey, this is what's likely going to happen. You know, the inverted yield curve, which I'm going to go more in depth with it. We've discussed this several times in this channel, but I'm going to have an economist for the St. Louis Fed, Christopher Neely, describe what the inverted yield curve is and understand a little more about it, so we can fully grasp what's likely going to take place in the future. And again, we're using multiple leading indicators. We're going to talk about and go in depth more of one that's very powerful, that has been very accurate through over the course of history. In order for us to make value investments, we need to know and be able to accurately, with higher degree of certainty or higher degree of probability, what's going to happen in the future based on what we're seeing take place. And right now we're seeing things continue to slow down. They're just taking a long time. So does that mean everything's clear and good right now, with price being all-time highs when we're going into a slower economy? Is that the right time for you to make investments? That's something for you to consider. But let's shift gears. I want to move on to this Fed economist, and this was brought by a channel called Rebel Capitalist. George Gammon brought this up. I watched one of his videos, and then I went into really in-depth detail of who Christopher Neely was and what role does he play at the St. Louis Fed. And this guy is he seems to really be intelligent, can articulate what he's describing very well. So I want us to take a listen and analyze what he's saying. So we'll get started with this.
The probability of recession, as predicted by yield curve indicators, is relatively high for recession in the next year or so. And this is consistent with the FOMC's recently restrictive monetary policy.
Hello.
Okay. What is he saying there? The inverted yield curve. Why is it an accurate predictor? I have up here your 10-year and 3-month Treasury yield spread. Don't get lost in this. We're going to go more in depth. I'm going to let him explain this. What you need to know is the shaded areas are recessions, and then that green line is when the yield curve, below that was when the yield curve becomes inverted. So this goes back to 1962. We had a false alarm here in the late 60s where it became inverted, but we did not get a recession. A few years later, we got another inverted yield curve, and it followed by recession. In the 70s, inverted yield curve followed by recession. 80s, inverted yield curve followed by recession. Late 80s, early 90s, recession. 2000, dot-com bubble, recession. 08, 09, that's another recession led by an inverted yield curve. And here's we are today, deeply inverted right now. Does that lead to a recession? Maybe. We'll find out.
This is concerning because past yield curve inversions have reliably predicted recessions. That is, sustained downturns in economic activity as defined by the National Bureau of Economic Research. This concerns the FOMC because it has a congressional dual mandate to maintain stable prices and maximum sustainable employment.
Oh boy. All right. We already went into the R word, recession. So tell me, Chris, what is a yield curve and what does it mean when a yield curve, like you said, is inverted?
Well, a yield curve is just a picture of interest rates or yields on bank deposits and bonds with similar risk characteristics at a point in time. That is, a yield curve describes how short, medium, and long rates relate to each other at the same time. Short rates are usually lower than long rates. In other words, 1-year yields are usually higher than 5-year yields, which are usually higher than 10-year yields. So the yield curve usually slopes upwards if you graph those yields by maturity. When short rates are about equal to long rates, that's called a flat yield curve.
Okay.
An inverted yield curve is one in which short rates are actually higher than long yields. In other words, an inverted yield curve means that the yield curve is sloping down instead of up.
Let me give you a quick mental picture of that when he's saying sloping. So you have your short term, let's say it's starting on this axis or this on the left of me. Well, your right, my left. Shorter term, let's say this, as I go up, the yields increase. The return on your investment increases. So it goes, your shorter term yield less, your longer term start to give you a higher return on investment. Simple as that. And when we have an inverted yield curve, your shorter ends return more and your longer end return less. And that's a sign of sickness. But I'll let him speak.
Why? Why would an inverted yield curve predict recessions?
Well, there are several stories about why an inverted yield curve might predict recession. Two of the most common stories are that Fed tightening raises short rates, and this action makes it more expensive to borrow for investment and consumption, and thereby slows the economy. A second and related story is that interest rates should be related to expected economic activity, and when medium and long rates are relatively low compared to short rates, that indicates that in the future there's going to be low desired investment and lower growth. But, I should note that there's nothing special about a yield curve that happens to be slightly downward sloping as opposed to flat. Both predict reduced economic activity in the future.
When the Fed raises interest rates, they raise it at the shorter term level. That's why we get that inverted yield curve. Interest rates are high because the Fed has caused them to go up. And making the shorter term what people borrow on, banks borrow on, makes the access to capital, the injection of capital into the economy, much more difficult and much more expensive, which is why over a longer term, because of the higher short term, there's damage done to the economy. It starts to show signs of weaknesses. It shows signs of lack of investment because now people aren't investing in the economy. They're putting money in savings, money market, cash equivalents, protection in the short term.
I follow some economists at the New York Fed and use the spread between the 10-year yield and the 3-month Treasury yield. If one looks at a graph of the 10-year yield minus the 3-month yield, that is the 10-year 3-month yield spread, one sees that this spread is almost always positive. That is, long rates are almost always higher than short rates. But when the slope of the yield curve declines, that is, when the 3-month interest rate rises relative to the 10-year yield, or equivalently, the 10-year 3-month yield spread declines, a recession becomes statistically more likely. A negative spread, that is, an inverted yield curve, has preceded each recession since the 1950s.
Oh, wow.
So all he's telling us there is that this inverted yield curve, one of the leading indicators, is a powerful predictive tool of a recession because nearly all the time, since the last 140 years of the U.S. when we really started to become an industrialized, started to be a powerful economy, the only time we got an inverted yield curve was prior to a recession each and every time. However, there were some false positives. But if you look at those false positive time frames and what was going on in the society, what was going on in the economy, they're just so different than what's taking place right now. Each periods of false positive need to be analyzed individually. And maybe that's something we do for you here. So this last clip, it's a little funny, a little I would say a double negative, and we'll discuss it afterwards. Just listen.
So is there any reason to doubt the current predictions of the yield spread? So I think we've all heard or read in the headlines that a recession is coming, quote unquote, in the next 6 months, but it also hasn't happened yet. So could it be wrong that it's not predicting that?
So, yeah, there actually is reason to doubt that the nominal yield spread has its usual predictive power right now. So the normal practice has been to examine nominal spreads But there are also good arguments for looking at real, that is, inflation-adjusted spreads. In particular, real interest rates should be more closely related than nominal rates, both to the stance of monetary policy and to expected future growth. So, if one does this and one corrects the 10-year 3-month spread for expected inflation at those horizons, using inflation expectations from survey measures, the real interest rate spread also implies an elevated but lower probability of recession in 12 months. That is, it implies a probability of recession of about 40%.
Okay, so lower.
So I should note that this 40% probability is the highest probability in the history of the series, however, exceeding that even given in an actual recession. So,
Did you catch that? See, what he said was, a better indicator, a better leading indicator that we use is the yield curve, inflation adjusted. But yeah, also by the way, that's inverted too. But that's actually only showing 40% probability of a recession. But yeah, actually that yield curve is showing a higher probability than it ever has in history, even during the great financial crisis 08-09. That's what he said. So pretty interesting take on that. I think there's a lot of honesty, but it also of, if something doesn't happen, we're using probabilities right now. We're using likelihoods, and obviously you can never be sure. You have an 80% probability of something happening. Well, you still have a 20% chance of it not happening. Which side of that bet, of the 80-20 or 70-30, would you prefer to be on? That's what you need to ask yourself as investors, and then also know the time frame on your investment. If you're just swing trading, day trading, monthly trading, maybe you don't care as much. But if you're, hey, I'm going to make long-term investments right now, maybe you want to think twice and make a different investment plan. Or if you say, hey, I'm going to hold it for 10, 30 years, I don't really care, and that's your prerogative. However, us as investors, we pick our time frame based on what's going on in the business cycle, what's going on in the economy. Sometimes we're making shorter trades, sometimes we're making medium-sized or medium-length trades, and sometimes we're making long-term trades. It depends on what the economy gives us. It depends on what opportunities lie and it will wait for us. So maintain flexibility during this year. Next year is going to be critical to what we believe is your success, our success. And we'll keep you navigating through this. Expertise you deserve, experience you can count on.